Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Jeff Horowitz, Chief Compliance Officer at BitGo, an institutional digital assets financial services company. He's also the former Coinbase Chief Compliance Officer. Jeff joins me to discuss what the FTX implosion shed a light on as it applies to digital asset market structure. Jeff, it's great to have you with us. Welcome to Trade Talks.
Thanks for having me, Jill.
You got it. And why is there a need for separation of powers within the digital asset space?
Sure. So the market structures where customers have to keep their money on exchanges is just kind of fundamentally flawed. You don't have to know much about crypto to see that's not a good idea. The Nasdaq isn't a custodian; they're an exchange, just like the New York Stock Exchange. But that custody is outsourced to broker dealers and ultimately to the DTCC, right? So I think we need to take a separate look and go back and figure out, well, why do we allow exchanges to hold customer assets on exchange? And after the FTX implosion, you see all of the challenges there, right? Where you have affiliated companies where those funds are not fully segregated and not in their customers' names.
Why is it important to have secure custody?
Well, when you leave it on exchange, it's susceptible to a hack. So BitGo keeps the majority of their assets in cold storage, which is in a class 3 bank vault with computers that have never touched the internet, and it's totally offline. We shard keys, and we actually go into a vault to actually move assets. But when you leave assets on an exchange, they're susceptible to hacking, password stealing, and once those assets are moved, they can't be reversed.
Do you expect regulators to increase enforcement and create a framework for regulated custody?
Well, unfortunately, we're living in a time where we're getting guidance through enforcement actions, and even Commissioner Pierce has been outspoken about her view that that's not the way the SEC should be leading. But that's kind of where we're at today. And it's done a disservice to investors and to consumers. You shouldn't have to have a clarity of what's considered a security or a commodity by reading enforcement actions. That doesn't mean we shouldn't have enforcement actions for egregious behaviors, but FTX was not a crypto issue. That was an outright fraud, very similar to Madoff. And so, but the reason we're in that place is because many exchanges have moved overseas because we haven't gotten clarity here in the US. And that's resulted in less consumer protection and challenges around bankruptcy protection.
And that was my next question to you. Why are many exchanges operating ex-US? And what does this mean for the consumer? Although we've seen firsthand what that does mean for the consumer when you can't access your assets.
Yeah, right. So lack of clarity, innovation is going to go outside the US, right? Either, in Europe, they have MiCA, where they're trying to work on a regulatory framework, which is a good first step. Here in the U.S., Gensler said, "Well, have exchanges come in and talk to us." Right? They may be required to be regulated just like Nasdaq and the New York Stock Exchange. But until we have clarity that that's not just, "Hey, we would like you to do this. This is a requirement," people are going to go where they can continue to innovate and continue to build products. I would like to see the innovation start here in the U.S., and I think that starts with some regulatory clarity. Hopefully, we'll get some clarity around stablecoins this year, and maybe around requiring that folks have their funds with regulated, independent custodians is a good first step.
Right. So what risk management procedures would you like to see standardized for the digital asset space? Would it look similar to what we see with equity market structure?
Yeah, so we built our program very similar to what a broker-dealer would look like, right? You could look at the AML and the KYC. There are enough regs out there that you could look what are the right first steps. But beyond that, I think we need to work on that regulatory framework, right? That you as a consumer should want your assets with a regulated exchange, regulated custodian. Not all custodians are created equal. Some are just software providers. But BitGo, we're actually regulated by South Dakota and New York as trust companies, and we go through exams just like you were Citibank in New York City with a branch office. That's the level of scrutiny that we should go through to make sure that your assets are fully segregated in the customer's name and bankruptcy remote. So if we go out of business, your assets are still your assets.
Right. So essentially, Jeff, BitGo operates as a custodian using equity-like risk management, but in the digital asset space. It sounds almost identical.
Yep. Yeah. I don't look at us any different other than we're a new asset class. But I don't think we need to call every digital asset a security to achieve that same level of compliance. Whether Bitcoin, is a commodity, but Ethereum may be a security or a commodity. I think the industry knows what it needs to do, but we need some clarity from our regulators and give us a way forward. The industry wants to be compliant, but we need to know what the actual rules of the road are so that we can actually build these products here in the US.
All right, Jeff, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks for having me.